Does the binomial model converge to the Black-Scholes model? Have you ever wondered how different models in options trading relate to one another? Today, we will tackle a fascinating question. Does the binomial model converge to the Black-Scholes model? To answer this, let's break down both models and their connection. The binomial option pricing model is a method that uses discrete time intervals to model the price movements of an underlying asset. In this model, the asset can either move up or down by specific factors at each time step until the option expires. This approach allows for the calculation of option values by working backward through a binomial price tree. It also accommodates American options, which can be exercised before expiration. On the other hand, the Black-Scholes model is a continuous time model that provides a closed-form solution for pricing European-style options. It assumes that the underlying asset price follows a continuous stochastic process known as geometric Brownian motion. This model relies on constant volatility and risk-free interest rates to derive option prices. Now, here comes the interesting part. As the number of time steps in the binomial model increases indefinitely, the option price estimates produced by the binomial model begin to approach those generated by the Black-Scholes formula. This convergence occurs because the discrete distribution of possible stock prices in the binomial model starts to resemble the continuous log-normal distribution assumed by the Black-Scholes model. Mathematically, this relationship is supported by the central limit theorem. This theorem indicates that, as the number of trials increases, the binomial distribution converges to a normal distribution. This aligns perfectly with the log-normal distribution of stock prices used in the Black-Scholes model. In practical terms, this means that for European options, if you use a sufficiently large number of steps in the binomial model, the resulting option prices will closely match those calculated using the Black-Scholes model. However, the binomial model has its advantages. It can handle American options and dividend payments more flexibly than the Black-Scholes model, which cannot account for these factors directly. Traders and analysts often prefer the binomial model for American options or in situations where the assumptions of the Black-Scholes model do not hold true. Meanwhile, the Black-Scholes model is favored for quick analytical pricing of European options. In essence, the binomial model serves as a more general computational approach that, with enough time steps, replicates the results of the Black-Scholes model for European options. This relationship helps traders navigate the world of stock and options trading more effectively. So, the answer to our question is yes, the binomial model does converge to the Black-Scholes model as the number of time steps increases.